About it with Jason Brady, President and CEO of Thornburg Investment Management, and Hugh Johnson, Chairman and Chief Investment Officer at Hugh Johnson Advisors. Welcome to both of you, Hugh. It's good to see you again. You say that the S&P is modestly overvalued by about 8.5%, but you are also simultaneously a little worried that it may be lapsing into that sort of level of exuberance where things get troublesome. Why do you say that?
Yeah, Tyler, good point. I think we've moved from what we might call a very rational stage of investment into something a little less than rational. Now, I wouldn't say we're seeing that the level of optimism objectively measured is getting a little bit higher. It's about double what it was a month ago, and you don't like to see that. I would not say, though, and I would caution everybody, I would not say that this is sort of moved into a state of exuberance. I don't think it's moved even further than that into euphoria, which really bottom line says, yes, we're overvalued, and that's not good news. But I don't think that this is sort of a mania as of yet. It could get there, but I don't think we're there yet. We're just simply overvalued, and that's going to be sort of a headwind that we're going to face for the remainder of December, and I think the first part of the first quarter. Yeah,
you cite as signs of potential exuberance such things as the performance of Bitcoin, the performance of IPOs and SPACs, among others. This is the year of the SPAC, Jason. But let's talk a little bit about the idea, if the market is in fact overvalued by a little bit or a lot, however you want to see it, what has to happen in 2021 is that earnings have to grow into those valuations. Do you expect they will?
Look, I think we're in the midst of a transformation to a cyclical recovery, and the market has discounted a lot based on what the Federal Reserve has done. So as we look at it, the Fed has been Santa Claus to growth stocks, but it's really been Festivus for value investors. They've got a lot of problems with those people at the Fed. And so as we see that cyclical recovery, you should see earnings grow into the value names. I'm not sure earnings can grow into the growth names. So I think that rotation is significant.
All right, let's talk about one area that you really like, and I want to drill down on it and get some names there, Jason, and that is banks. Why do you see 2021 as a good year for banks, both good and mid-sized?
Well, first of all, those are quintessential value names. You talked about energy stocks outperforming. As we look at the market, bank stocks from a sector perspective are right there, right? At the same time, when we're seeing reserve releases on the horizon for banks because they reserved so much for the COVID pandemic, and now those come out, plus the recent news from the Fed saying, hey, look, not only can you release those reserves in earnings, but you actually pay them out in dividends because your balance sheet is so good. This is really a great catalyst in the context of some of that rotation. And it's just a really good way for investors to balance the rest of their portfolio, which probably for many folks has gotten very, very heavy into tech names and things that are very growthy.
I think, Jason, you and Hugh might agree that sort of cyclicals look like a play. I see, Hugh, that you like consumer discretionary industrials, some technology and materials. But where you two disagree, it seems, Hugh, is on international shares. You do not favor them except for emerging markets. Jason, you do favor them. Let's get that one going. Hugh, you first.
Well, yeah, favor is a very strong word. I don't favor them. I underweight international. The primary thing I look at, quite frankly, is the relative performance. It's been a long time now that relative performance of both emerging and developed has been very poor. In other words, they've underperformed the S&P 500. And quite frankly, as a part of my discipline, I don't like to buy things that are underperforming the S&P 500 when my goal or objective is to outperform the S&P 500. Plus the fact, when I start to do the numbers, I don't think that prospects, quite frankly, when I look at developing or emerging, although emerging is starting to get better when you see China starting to post some pretty good numbers. The truth is that the numbers are getting a little bit better. It's starting to get a little bit closer of a competition, but I've got to see much better relative performance. And of the two, emerging is outperforming developed. And so that's where I would put, if you're going to put something in international, I would make sure that you underweight international, but you overweight emerging versus developed.
All right, let's let Jason get in here. You say that the shift from U.S. as 2020's market leader to international names is in full tilt. How do you respond to what the case that Hugh just made?
Sure. So obviously, emerging markets are part of that. So I agree with that piece. And frankly, China is a growing portion of emerging markets, something that we pay a lot of attention to at Thornburg. But I think my view on developed international is pretty much in keeping with what I just talked about around some of that rotation. So the U.S. is much heavier weight into IT. Outside the U.S., much less so. You've also seen a little bit of the loss of American exceptionalism around rates. So with the Fed keeping rates very, very low and real rates very, very low, what you see is the decline in the dollar. And we expect that to continue to be a pressure on the market. And frankly, for a U.S.-based investor, looking internationally for some diversified returns is a good idea here.
All right, gentlemen, thank you very much. Have a great holiday season.
Shepard Smith here. Thanks for watching CNBC on YouTube.